Hey, I'm Matt Hudgens and he's Dave Mulvaney, and this is Profitability MD. Dave, how you doing today, buddy?
Great, Matt. How are you today?
I am doing great. Very excited. Very excited. This is episode 158, and we got a good buddy of mine, Mr. Brett Fellows, who's coming here to join us. So I'll give you a brief bio on Brett, and then we'll get into asking him some questions. So Brett is from Boston, right? From Boston, and that's crazy. Ended up now he's in Charleston, South Carolina. Investment advisory business for business owners, retirement and tax planning, exit planning for business owners. You started out your career as an entrepreneur in the golf business. I looked it up. It said Sagamore Golf. So you were like a public golf facility up there in Boston, and started that back in '94. So you were telling me '97 when Tiger Woods, get it off. But now your main business is helping other business owners with retirement and exit planning type stuff at Oak Capital Advisors in Charleston, South Carolina.
Yes. And it all ties together, Matt.
It all ties together. Your entrepreneurial journey. Well, how about that? How did you know, or when did you know you were being an entrepreneur?
Yeah. So I started in the golf industry, like you said, Matt, in '95, just through family members. The only reason I got it. And we had one daily fee course, 20 minutes outside of Boston. So in terms of proximity, it was very close. And in 1996 of October, there's a guy by the name of Tiger Woods who turned professional. Yeah. You may have heard of him, and golf as an industry absolutely skyrocketed. And we were frankly at the right place at the right time. And so we would be open from 5 a.m. as the first tee time, and the bar would close at 11, and just continue. Every 9 minutes, you get 4 people, all cash in the day. And it was fantastic. And then from there, we merged with another golf course in New Hampshire. And then eventually we built a facility, a 50-person grass tee, indoor, outdoor driving range.
Wow.
And at our height, I think we probably had 150 employees or so, most of them, maybe 25 full-time, the rest seasonal. Our Boston golf course was the busiest golf course north of Boston. So
really?
Yeah, we would do about 48,000 rounds in a 6-month season.
That is huge.
Yeah.
That's absolutely
it was
huge.
all gung-ho. The problem, so you fast forward to 2002, 2003, the market had gone down tremendously. I think it lost about 50%. And so all the baby boomers started to retire in the early 2000s, and real estate was going up. Now, I was part of the operating company. I had ownership in the operating company, but we didn't own the land.
Okay.
And so the trusts that own land were getting offers, millions of dollars per acre. And here we are writing a little rent check, which didn't quite. So, and in fairness to all the trustees, that is a couple of generations, so it was pretty diluted. A lot of them just wanted to sell. And this is when we started to have children and weather and all of these things you might hear of if you talk to people from the north. We were afraid we were going to lose the Boston golf course, and I was going to have to move to one of our facilities up north, and or we were going to buy another one. But I just had 10 years, kind of burnt out, and just really needed a change. And so I didn't want to leave Boston. I didn't want to go further north. And my wife and I said, you know what? We've never really done anything in our life. We grew up in Boston, went to school in Boston. We lived where we grew up. We said, let's just take a chance and do something different. Worst case, we'll come back and just continue on. And so I was able to sell my shares in the operating company, and that led me down to, we picked Charleston to move. And I had a finance background, and I had some people skills from the golf industry. So I said, I never made a paycheck from anybody. I always paid myself. So I was going to continue to work for myself. And I figured, well, everybody's going to retire to Dave's neighborhood in Jacksonville or Charleston. We visited Jacksonville and Charleston. Sorry, Dave, but if you look at the two, it was kind of a no-brainer for us. So we loved Charleston. And so we chose here, and people were going to retire. And so I said, well, I'm going to get into financial planning. And that eventually matriculated into target marketing more towards, or a niche of a business owner. And because that has frankly been my experience.
Right.
And this is the Profitability MD. What was pretty interesting too about the operating company was a lot of it was owned by two different generations of the same family.
Sure.
And this was a huge profitable business. And so it couldn't figure out how to pull, the older generation couldn't figure out how to pull the equity out and have the younger generation buy it.
Right.
And the money was there to do it, but they couldn't agree on how to do it. And
Well,
so that always stuck with me to say, like, and working with as an advisory practice, how can a business owner work all these years and then perhaps if 80% of their net worth is in the business, how do they pull out that equity and use that for retirement?
Right.
And so that's what brings me here today.
That's exactly right. So same kind of concept where how can the business owner use the business to generate wealth? That's really what you're saying. And they were having trouble exiting the wealth. One thing that the golf business you just described is really talking about, we talked about the 4 pillars. So you have a business that generates cash flow, and that cash flow is used to support your lifestyle, but also to buy real estate. In this example, that real estate was worth more than the operating business itself.
That's
which,
correct.
by the way, that happened exactly to one of my clients, barbecue restaurant here in Atlanta, and they go to sell it. They got 3 locations. Ended up, we're going to sell the business. The real estate was worth more than the business. So, McDonald's, they don't sell hamburgers. They really sell the hamburgers to pay the rent.
Yeah.
Right. And in essence, your operating company of your golf was paying rent for the land, but the real cash was when they.
Yeah. And that's frankly why, in full disclosure, why we were so profitable is because we weren't paying a huge mortgage on real estate.
Right.
So we were able to cash that in, but it bit us on the backside when the land might go away.
So
by the way, it's now 2021. The golf course is still there.
Oh, okay. That's a whole different story. What were you going to say, Dave?
So, well, I've got a question. Okay. I know a lot of people from Boston and you don't sound like any of them. Okay. How is that even possible? It's like, you can't take Boston out of a person. You said you were born and raised in Boston.
Yeah. If you grow up in Boston and you really listen to how your friends speak, if you have half a brain, you're going to learn how not to speak like that. Give me a couple of beers and it will come out.
That's great. I'm glad we don't have any followers that I know of in Boston.
Boston, right.
Other than perhaps you. So, but what do you think? So as you transitioned into a new business around the financial industry, what do you think was like when you were starting out? What was the biggest obstacle you had to overcome coming out of the golf business, which is all customer service, like people coming to you, and then all of a sudden having to transition probably where you had to go out and actually get clients to work with you. What was the biggest challenge you think you overcame there?
Well, it was twofold, I think. And I never should have done it. I never should have been in financial advisory. They never should have let me in the door because for all the reasons you just said, Dave, the only reason I made it was because of money. It was because I had money from the buyout from the previous business. And so I had a few years buffer.
You had a runway. You had a runway to get the business going.
And so if I didn't have that, I would not have made it. Absolutely. Right. For multiple reasons. And the second part of that was my wife. My wife is a CPA, and she was I'm fortunate enough, and even with our girls, I tried it for a few years. We knew we were going to start to run out of the money, and we frankly switched roles. She went back and she became a CFO of a corporation here, and I picked up more of the picking up the girls from school, cooking dinner, more of a lifestyle practice, which frankly gave me more runway. Because I wasn't working 40, 60 hours a week. I was maybe only working 25 hours a week, but that took a lot of pressure off me having to produce, because Dave, I would not have made it. The hurdle was so big in this space, especially when Matt and I started. It was very transactional. I didn't know a soul. So it's network-based, relationship-based. So it was really tough.
That's interesting. Because, I mean, you work in 25 hours a week. That's almost 3 times what Matt works now.
That is a great point.
Hey, but I will say you become so successful now, the roles have reversed back, right? Your wife has now.
Yeah. So in 2019, my youngest started driving. And so all of a sudden I had about 20 hours back on my time. And so we flipped back, if you will. So I came back or started to work all the time. I said, okay, now I really have to gear this up. And that's when I really marketed towards the business owner and got very serious about that. Colleen stopped working, and she is actually working for us now, as doing all of our books and some paraplanning work for us, which has been fantastic. And since I started to put that effort back into the business, it's been up 50% a year just by the attention.
Right.
So I've been very, very fortunate.
So I noticed your business actually follows two of the pillars of what we call two of the pillars. So, and I kind of gave you a little overview of what the pillars are, and Matt talked about them earlier. So, of course, maximizing business value, which is, we talk about building a business as a tool to build wealth, and then growing and preserving wealth. And then, so tell me about how, okay, so we're not, this is just what Matt and I talk about. What made you focus on those two pillars? What was, I mean, I'm just curious, what made you focus go to those two pillars?
I realized, frankly, early on how amazingly profitable this business was. I just had to figure out a way, or I just had to last long enough to stay in it. Because I knew, frankly, when you get to a certain point, the expenses are almost fixed. Might be 30% of revenue at the most, and then even it could stop at a certain amount, and then from there it is highly profitable. So that, I guess, leads me to the next capacity ceiling is I can only do so much because we sell our time. At what point do I necessarily make the team bigger? If I go from a solopreneur to a small ensemble, do I necessarily keep the same profit margins? Not really. That's the moving forward. That will be my biggest hurdle, is how do I consider the practice and keep it as profitable as I can? And what does that look like long term? In our world, we can sell it, or we could possibly align with another firm that's bigger and they would actually purchase our business. So those are the two main routes to go.
Or run it forever into the ground.
Or run forever. That's right.
Which is probably, you're exit planning guy, right? So you talk about that all the time, that X number of businesses don't ever end up selling, right?
Yep.
I think it's a big number. I think it's over 80 something, 83%.
86%.
Yeah, it's a big number that they can't. I mean, we talk about this all the time, why they can't sell, because they're the business most of the time.
Yep.
So, Matt and I stress the fact that, okay, you got to siphon money off this business legally, of course, and utilize that to acquire other assets that will produce not just cash flow, but tremendous tax benefits. One of the reasons that, real estate is such a big piece of what I believe that people should have outside of their business, because, I had a business that crashed and burned, and if it wasn't for real estate, I would have been done. So,
do you guys think that's changed post-COVID, especially commercial real estate?
Oh, wow. So, here's the thing. I'll tell you that right now, commercial apartment buildings are the most compressed capitalization rate in history. That won't last forever, of course. So, why our apartments great is because you can get cap rates really low, but you can borrow at 3.5% and inflation is 5.5%.
Yeah.
So you're killing the market with that. However, what's really, really bad in real estate right now are certain parts of the country. And so knowing where to invest is very important, but also certain parts of the like hospitality, there's not a bank on the planet that'll give you a loan on a hotel right now.
Yeah.
So even though hotels are bad, and multi-purpose is bad, there's always something good. Real estate has always been a hedge. I don't think anybody should have all their eggs in the real estate basket and then not have any investments, because real estate can haunt people.
Yeah. And that's one of the things though, too, though, would be the first thing you probably should do is your own office building, right? I mean,
Yeah, I say we're looking in September of buying this space.
yeah. So there you go. It's exact same. Yeah. And that's usually what we recommend is you have a business and then why not own your own place, right?
Yeah.
Because now you'll get the depreciation benefits, the tax benefits of owning instead of renting,
Yeah.
as well as the appreciation, right? You're using the, now
And
you're
also,
like,
I think takes pressure off having to sell your business for as high as a number. You know, we have some hair salons or heating and air companies that own the buildings,
right.
but they're also getting rent.
Yes.
And then even if they can't sell the business for the price they want, well, they at least know that they're getting the rent from the building.
No, you're exactly right. It goes back to like talking about the barbecue place that I was talking about. I've got dentists. We always talk about the dentists, and
Yeah.
I suggest the dentists buy their practice, their office space, and then they could sell the practice itself, but hold on to the real estate and collect rent from the new dentist. So that's exactly what you're talking about. And that's what we mean about the 4 pillars, right? The business itself, and then that real estate, it could appreciate that you could sell, like your golf example, or it could be that you keep it and that provides cash flow, which,
Yeah.
Dave always talks about a cash producing entity, which adds to your exit strategy, right?
And so what's the fourth one?
So the fourth one would be wealth accumulation account. So
And cash flowing assets. So those are both
Okay.
kind of hand in hand. So I liken it to if your income from cash flowing assets, different kind, could be stocks, could be dividends on stocks.
Yeah.
If your income is such at a point where you can live very comfortably, you don't care necessarily how big the number is on the balance sheet. Most people want to have, I want to have X million in my bank account when I retire. Well, that's great. But the problem is if it's in your bank account, that's stupid because it's making the smallest amount of
Right.
income. But if you take that and you put it into passive investments like real estate that can be owned in an LLC, and you can be 100% passive, but because the money comes in through a K1 on an LLC, you also get the depreciation. And I'm not giving tax advice.
Mhm.
This thing, we're not giving tax advice, not giving investment advice. But that being said, there are tremendous tax benefits. But with real estate, when you stop buying, then that goes away. So it's really the final pillar is this wealth accumulation that produces income regardless of your age. Because everything that pillar 3 is about is building this nest egg of retirement funds, and you can't get them at them until you're 59 and a half.
Yeah.
But let's say some people start a business. I was 22 when I started my first business, and I've been self-employed since. If I have to wait till I'm 59 and a half, you could accumulate millions and millions of dollars in a fund, but you can't retire yet because you're too young. So that's what the 4th pillar is really: build an income streams.
Well, yeah, it's a place to put the money, right? So
yes. But what if I reverse that? What if I go the opposite? What do you guys think about not necessarily putting monies into retirement building, but since you guys are entrepreneurs, betting on yourself instead of betting on the market? You could make 20% as opposed to 8%.
Well, and that's great. Well, that's literally why the 4 pillars, right? So it's diversification as a key, right? So go back to your business itself, and in business, you just have a job where it pays just for your lifestyle. No, you want the business to really thrive. And that's what we talked about, the coaching to take it to the next level, because you want those other pillars, right? So if you buy the real estate, like the office building that you're in, Brett, now you'd have that. Okay. And then if you have a retirement plan, you're putting money away, pre-tax, tax benefits, building nest egg. And then you have this wealth accumulation account, which is basically after-tax money that you're putting over there. So if your business does hit a hiccup, you have other sources that you can draw the money from, right?
Mm-hmm.
You don't want to borrow from your retirement, but you could refinance the office building, right? You could borrow on margin from your investment account, right? So what we see happen, or the reason I came up with the 4 pillars was, real estate guys are notorious for that. They put all the money in the next deal, and eventually the deal crashes. So not just real estate guys, but if you put all your money just back in your own business, eventually your own business, well, Dave's an example, your own business will hit a hiccup. We have recessions every 7 years, right? So you need those other pillars or diversification to have other assets that you could borrow against or provide cash flow to carry you through the day, because every business is going to hit a recessionary period or a pullback period.
Yeah.
So I understand the concept of put it all back in my business. That's what I know best. That's why I get the highest return. Yeah, but you also need to diversify.
Gotcha.
We can't put everything in all in one basket, which is why we have the four pillars.
Dave, I don't know the full story, but what was the biggest thing you learned from what you went through?
Well, first of all, I was miserable in my business. So I think on a subconscious level, well, I will tell you this, open your own mail. That's the biggest thing I learned, because I had a bookkeeper embezzle $500,000 from us.
Oh,
So
wow.
the first thing I would recommend is open your own mail. I don't care how big your company is, but so what I learned was that I was following my own advice all the way along. I had assets, and when the business when the business went bankrupt, I had other businesses. I still have the real estate investments, and I had a lot of cash outside of my business. If everything was in my business, I would have lost everything.
Wow. Good for
And
you.
so,
Wow.
But then literally the next year, so when my business collapsed, it didn't affect my personal credit, because I was really responsible personally. And I literally went out and bought 11 houses, investment houses in a few months. And so I was back focusing on something else. But that's why I believe so passionately that people, if all your money is in your business,
Yeah.
it'll die with your business. Ask Sears. I mean, Sears, they went broke. The
That's right.
year they went broke, they had $4.5 billion in profit that year. They did $36 billion the year they went broke. How do you go broke on we did a podcast on that.
Yeah, we did.
How to go broke on $4.5 billion. But the point being, it doesn't matter the size of your business. A business has a way of consuming every single dollar you leave
Every
in.
resource you'll let it.
Everything you leave in it. So you got to put systems in place to move some of that money into other things. And now the business you can run the profits from, you can create an LLC and run profits from one LLC to another. That's fine. But you've got to find a way to get money out of the business. So over time, you have these other things. And if you don't love the business anymore, you could sell it. Provided it's self-managing, because you're in Dan Sullivan's coaching. So that's, Dan Sullivan teaches that create a self-managing business. I love that concept.
Yes.
So,
but
that's
great.
So what do you think is, you're still young. If your daughter is just driving, that's still young. What do you think? Do you think about an exit strategy at all in your business, or?
How about every other minute of the day? Yeah. I think ultimately I'm going to go more the route. I'm a softie, so I have trouble 80-20, the 80% of my business that only accounts for 20% of the revenue. I'm going to have a hard time cutting them off. And there's a point where, they keep the lights on. They were with me since I started. So I think eventually I am going to have advisors underneath me that will always be able to service them. Like a baseball diamond, if I'm at second base, I'll have an advisor on first and third, and at home base will be someone to help facilitate the three of us always working forward.
Right.
And then that would be, in the perfect world, that would be the succession plan, is that those two, as they got more and more involved in the business and time and knowing the clients, that would be the exit plan. Now, whether that's a daughter or whether that's someone unbeknownst to me yet, I don't know, but I'm looking forward to checking out all the angles of that. So that's ultimately, I think, is for this business is right now is to build it up enough. And that looks like 200 clients, 3 advisors, and then work on a 5-year type of exit plan.
What's awesome about what you just said, you're very specific on what it looks like. And
right.
Matt and I talk about this, most people don't think about what their business looks like when it's done.
Yeah.
And when it's done, it means it's self-managing. It's created, it runs by itself, and you just boom, like that. You already know what it is because you've thought about it. That's it.
Yeah. Yeah.
That's a great thought. So what would be standing in your way, you think, of getting there? Of the 200,
You're
200?
looking at them.
Oh, me, you?
No,
Wait.
no, me.
Oh, okay,
I'm my
sorry.
own worst
Sorry.
enemy.
Okay, all right. Yeah, I got you.
My own self. I still have, I don't know if, who knows what our minds do to ourselves, but I spend a lot of time on professional growth and personal growth. And I've done a lot of work with the last years. And I think that's part and parcel why we have grown so much the last few years.
Oh, I definitely think, I definitely think you, I mean, just in the last 3 years, you've grown so much and you're focusing on your niche and
there's
we
a
always
lot of
talk about,
imposter syndrome.
Yeah.
A lot of trying to sell but I didn't, because I was worried about making the money. But when you get to a point where you don't have to worry about the money, then it really transitions.
Yeah.
So I would say, Dave, ultimately it's me. And then the second part is to find A players
to join the team.
Yeah.
I like that. And you're working on the 4 pillars. You didn't even know you were the 4 pillars before you got on our call, but
yeah,
you've got the businesses producing excess cash flow. You're talking about possibly buying your own real estate. I'm sure you got a retirement plan.
Yeah.
And I'm sure you have like a wealth accumulation account, an investment account, after tax investment account. So you've
I don't know if I'd always too want to stay in the advisory. I'd like to keep it perhaps self-operating organization, but then maybe do something different too. So we'll see when that time comes. And it could be a spin-off of financial planning. Maybe it's business valuations or something, just add a different facet to what we do. At the end of the day, I am more of a business owner than a financial planner. I would say that.
That's good.
I think I totally agree with that. Yeah.
And that can be the 4th pillar is literally buying other businesses.
Buying another business.
Yeah.
Buying more businesses because you're good at owning them instead of necessarily running them.
Right.
Yeah.
Exactly.
Let's structure it and put them together.
All right. What's a good book you've read recently?
Every year, this is a little dated, but every year I always go back to E-Myth. I don't know why, but that one's always rung true to me. I like the traction books.
Right.
Yeah, I love the idea of the implementor. And Matt is what's the other one, Matt? You're the visionary. Yeah.
Which one are you? You're gotta be, which one are you?
I said 5 years ago, I would have said I was the implementer, but now I definitely think I'm the visionary.
Yeah, I think you're right. I think so.
So I would say those.
So E-Myth, it's funny. I've read that so many times. That's the problem is I'm not an implementer, and E-Myth is all about
implementing. Yep.
Yeah.
Yep. That's what I mean about the A players. I need to find somebody to implement that.
Right.
And having had so many employees in the golf business, to now having 20 or however many years I've been doing this with just, a solopreneur, it's hard to go back to managing people.
Yeah.
So I really want to be intentional on who that person is and why.
Well, you mentioned to the daughters, you have 2 daughters that are in college. Have they expressed an interest or is
no?
Okay. That's just your own kind of, well, maybe. Yeah. Okay. I can appreciate that. I got 2 daughters in college.
We'll see.
All right. So, one of the other things you talk about is that you got your target market. We talk about your business owners. You got your, $1 million message, where you help, financial planning, retirement planning, tax planning for business owners. And then what is your offer? I saw on your website, you've got a free
financial retirement readiness assessment.
Yes. Yeah.
Essentially, this is a very commoditized space. So before anybody pays me anything, I'm looking for a long-term relationship. I really want to make sure it's a fit. I really want to do my due diligence. So we put them through a pretty arduous process of working with us. And then the retirement readiness assessment is maybe a 7-page. It's a 30,000 view of their readiness, and we'll make some recommendations. And then from there, if they don't want to work with us, that's 1,000% okay. They take it. I want them to take it. I want them to bring it to another advisor, see what the other advisor says. I want them to, or use it to implement themselves. But I like to have them something tangible before they decide to work on it with us. And it's a
Right.
lot of work. It's probably 10 to 15 hours worth of work.
Yeah. Yeah. It's real stuff. I mean, it's
Yeah.
very tangible.
Yeah.
So they can get that at your oakcapitaladvisor.com, and in the upper right-hand corner,
Yep.
upper right-hand corner, it said free financial roadmap or something like that. Click on
But
it.
the goal is to exit. I love it. Exit your business on your terms. I love that. And so I know we're coming to the end of the show. One quick question. What is, if you wouldn't mind, what's fee only financial planning? If that can be done in a short, what does that mean?
Yeah. So that's a great question. Fee only for us is a stated fee. So we will agree with a client in our engagement standards of what that fee will be. And for us, it's one of two ways. It's either a certain percentage of the asset under management, and or it's a monthly subscription fee. And oftentimes it's a mixture of the two. But at the end of the day, there will be a stated fee for each client. And that's it. That's the only money we make. There are no commissions or agreements with custodians, that sort of thing, which was very, very predominant in our industry for years.
Right. A fiduciary. Tell them you're fiduciary, right?
Yeah, as a fiduciary. That's correct. It's a big word.
Big word in our industry. Yes.
Yeah.
Fiduciary duty to put your interests, their interest ahead of your own.
That's correct.
Which is different than the brokerage relationships.
Yeah.
Well, that was good. This was good exploring. I appreciate you taking the time.
Well, thank you, guys.
Come on and visit with us, and we got to learn a little bit about your golf background. And you still play golf now. I know it's only January, February. So have you played much this year?
I try once a week. I'll try. I just pretend I want to be Matt Hudgens.
Then you play as much as you want, wherever you want. And if you're
That's right. That's right, Dave.
Some of us have to work though. So.
Yeah, some people, somebody's got to do it. I don't know, somebody's got to do it.
Yeah.
Well, this was good stuff. Thanks for being a host.
Thank you.
Guest, episode 158 with Brett Fellows, Oak Capital Advisors. And thanks a lot. We're going to stop recording and hang
All
on.
right. If you can reach us at Matt at Profitability MD or David at ProfitabilityMD.com, and find us anywhere that podcasts are played. All right. Take care, guys.
Thanks.